For more than a century, the US stock market has delivered impressive long-term returns. Historically, the average annual return has been around 8 to 9%. In more recent decades, that number has even ticked higher, with the market averaging closer to 10% per year. These consistent gains are the reason so many investors have trusted stocks as the foundation of their wealth-building strategies. But many of the largest financial institutions in the world are now warning that the next decade could look very different. Instead of the high single-digit or double-digit returns investors have become accustomed to, these firms expect the stock market to deliver much lower gains. Goldman Sachs is one of the biggest names to sound the alarm. In its most recent global strategy paper, the firm stated that it now expects the S&P 500 to deliver an annualized nominal return of just 3% over the next 10 years. Adjusted for inflation, that drops to barely 1%. According to Goldman, this estimate falls into the 7th percentile of all 10-year returns going back to 1930. In other words, very few decades in history have been as weak as what Goldman predicts for the future. The firm went further, noting that with 10-year Treasury bonds currently yielding around 4% and inflation expectations hovering near 2.2%, equities will face a stiff competition from other asset classes. Goldman estimates a 72% probability that bonds will outperform the S&P 500 through 2034 and a 33% chance that stocks will even lag behind inflation. Vanguard, another investing giant, released its own updated forecast in July 2025. The firm also expects U.S. stocks to underperform their long-term averages. According to Vanguard's models, U.S. equities will deliver between 3.3 and 5.3% annualized returns over the next decade. This was a downward revision from their prior forecast, showing that their outlook is worsening. U.S. growth stocks, which have been the leaders of the past decade, are projected to return just 1.9 to 3.9%, 6 percentage points lower than previous expectations. Even bonds, which Vanguard sees as relatively attractive, were revised slightly downward, with expected returns of 4 to 5%. The firm explained that these estimates reflect the U.S. stock market trading well above its fair value. Vanguard calculates fair value using corporate earnings adjusted for inflation over the past 10 years, combined with prevailing interest rates and inflation levels. By those measures, today's market looks stretched, meaning future returns are expected to be more modest. Other financial giants are reaching similar conclusions. Fidelity has published a 20-year forecast that calls for nominal stock returns of just 5.7% per year, a far cry from the 10% average investors often cite. Charles Schwab has lowered its own forecast for U.S. equities to 6% annually, down from earlier, more optimistic projections. BlackRock is among the most upbeat, but even it predicts average annual returns of just 6.2% over the next decade, still well below historical norms. The common thread across all these forecasts is clear. Institutions that once encouraged investors to expect 8 to 10% annual returns are now bracing for something closer to 3 to 6%. Two primary drivers explain this pessimism. The first is tariffs. With frequent changes to U.S. trade policy, especially under President Trump, global commerce has become less predictable. Higher tariffs mean higher costs for both importers and exporters, squeezing corporate margins and dampening growth prospects. Financial institutions have factored this uncertainty into their models, which makes them more cautious about long-term returns. The second reason is valuation. By almost every popular metric, U.S. stocks appear expensive. The Shiller price-to-earnings ratio, the Warren Buffett indicator, and the Q ratio all point to valuations that are well above historical averages. High valuations often translate into lower future returns, because when investors pay more for each dollar of earnings, the potential for further price appreciation becomes limited. It is important to note that these are just forecasts. No one can predict the future with certainty, and history is full of examples where consensus turned out to be wrong. However, when so many of the world's largest investment firms agree on the same theme, it is worth paying attention. If these forecasts prove accurate, the implications are significant. For investors relying solely on share price appreciation in the stock market, the next decade may feel disappointing. Gains of 2 to 4% per year would pale in comparison to the double-digit surges of the past. But for those who seek income through dividends and other high-yielding assets, the environment could be much more favorable. For decades, technology companies have dominated headlines and attracted the bulk of investor dollars. Their rapid growth and soaring valuations made them the stars of Wall Street. But if growth slows and valuations remain stretched, the spotlight may shift back to sectors that have been overlooked, sectors that offer steady dividends rather than explosive growth. Utilities, consumer staples, and other traditional dividend payers still provide solid income streams. In a world where stock prices rise slowly, those income streams can make the difference between mediocre and excellent returns. Consider a simple comparison. If an investment delivers 10% per year in share price gains but pays no dividends, the total return is 10%. If another investment delivers no price gains but pays a 10% dividend, the result is the same, 10% per year. In an environment where stocks are only expected to return 3 or 4% annually, the second type of investment looks far more attractive. Goldman Sachs itself pointed out that bonds may outperform equities over the next decade. Many closed-end funds, which specialize in bonds and fixed income assets, offer yields of 8 to 12%. While their share prices may not move dramatically, their distribution stability makes them appealing. Vanguard echoed this sentiment, noting that bonds look increasingly attractive compared to stocks. Real estate investment trusts, or REITs, also stand to benefit, particularly if interest rates come down. While their yields are typically lower than those of closed-end funds or business development companies, they provide diversification and steady income. Business development companies, or BDCs, are another category of high-yield investments. Known for prioritizing dividends over price growth, these companies often yield between 8 and 12%. If stock prices remain flat, BDCs could significantly outperform the broader market. Perhaps the most compelling option in a flat or slow-rising market is covered call exchange-traded funds. These funds use option strategies to generate income, often yielding between 8 and 14%. They perform well when the market is sideways, but can also generate strong returns in other conditions. If the stock market truly delivers only 3 to 4% annual gains, covered call ETFs could offer far superior performance. The broader message is simple. If equities are entering a period of lower returns, income-focused strategies will shine. Whether through bonds, REITs, BDCs, or covered call funds, investors who prioritize yield may outperform traditional stock market investors over the next decade. The future is uncertain, and no forecast should be taken as absolute truth. Markets can surprise, and innovation can spark unexpected growth. However, the consensus from Goldman Sachs, Vanguard, Fidelity, Schwab, BlackRock, and others is clear. The golden era of high double-digit equity returns may not repeat itself anytime soon. For long-term investors, this means adjusting expectations and strategies. Instead of relying solely on share price growth, it may be time to pay more attention to dividends and income-generating assets. No matter how the market moves, up, down, or sideways, dividends provide consistent returns that do not depend on selling shares. If share prices stagnate, dividend investors will still collect income. If the market rises modestly, dividends will enhance those gains. And if pessimistic forecasts turn out to be overly negative, dividend payers will still perform well. In every scenario, income remains a reliable cornerstone. The bottom line is that while the coming decade may bring slower growth in equity markets, it also brings opportunity. Investors who embrace high-yield strategies and diversify beyond traditional growth stocks may find themselves well-positioned, even in an era of lower returns. If you're concerned about your financial security and are thinking about investing, check out the first link in the description. It's the platform I use, Interactive Brokers. Click the link to learn more. We hope you found this video helpful. If you did, please like and subscribe to our YouTube channel so you don't miss out on future uploads.